I don't know a whole lot about trading psychology. I'm not super disciplined and my risk management is okay. But if there's one thing that I'm good at, it's making 40 pips per day. And that's exactly what I'm going to show you in this video. In the last 90 days, I've made over $45,000 with one simple trading strategy and gained over $1.2 million in funding trading Forex and futures prop firms. I've gotten funded with Forex firms like Diversify, My Funded Futures, and Ascend Capital, to name a few. And in this video, I'm going to reveal everything you need to know about how to make 40 pips per day and make hundreds of thousands of dollars with prop firm trading. But before I get into the content, I have some bad news. If you don't have the attention span to watch this video for 5 minutes and take notes, then I'm sorry, but you're probably not going to make it. We're going to be talking about how to determine your daily bias, my 5-step system to entering highly profitable scalp trades, how to make 40 pips per day, Monday to Friday, how to get funded quickly, but in a safe way, how to make sure you get paid monthly as a trader, and breakdowns of my most recent trades with this strategy. That way you can see my exact thought process when taking trades from start to finish, and then you can replicate my exact process. And by the end of this video, my promise to you is that you will have all of the tools you need to make 40 pips per day and get funded in half the time. Right, so why the hell should you listen to me? Well, let me show you some live results. So on the 17th of June, I got a payout for $26,327 from Ascend X. Okay, this was a couple of months ago. I then managed to get a $18,310 payout from Effexify a week after that, which made up roughly $45,000 for the month. And then about a couple of days ago, I got another payment from Ascend X for $5,835. which was made in one single trade. Again, all of these trades were taken on stream in the Discord, which is completely free for you to join. So you can join in there, watch me trade completely free, and watch me profit with these particular trades. Okay, so let's have a look at my blueprint here. So the first thing you need to do is determine your daily bias. So let me show you exactly how we do that. Now, the first thing I want to tell you is that the daily bias is basically an overview of where you're going to be trading within. It's a rough guide. So think of it more in terms of trading as if you are sketching. When you sketch a face, you create the circle, okay, and you create a cross in the middle where you draw your eyes, your nose, and your mouth. This is the same thing. You want to be trading within these guidelines so that you can remain safe on the lower time frames. So let me show you roughly what I mean, okay? And we're going to go over real life examples of this really soon if you stick around till later in the video. But what I'm going to show you are these diagrams. So price pushes in one direction, it retraces, price pushes in one direction, retraces, price pushes in another direction. What you will find is that price then breaks structure and breaks structure, okay? That's what price does. It breaks structure and then retraces, okay? And then continues to break structure and then retraces. That's what price does, okay? This is where price has broken structure, okay? We then mark out the swing points in the market. Again, this is just a diagram. Yes, it's very simple. We'll look at price a little bit later on. We will then mark where price has swung back, retraced significantly enough relative to price, and then mark on the swing high, swing low, swing high, swing low, and so on. You understand what I'm saying? Again, this is a very rough technique for developing a theory on the bias and the general trend of the market. Now, again, very rough. You can still take trades against this bias. However, it is an added confluence when you're taking trades with the direction of this bias. That's the first part of this, okay? That's the first part of this, entering on the lower time frame in line with this swing structure bias. Now, the second part is easily one of the most important parts of the strategy, okay, which is for our support and resistance. Now, a support and resistance is pretty simple to mark out. Once again, it's where the market moves in a different direction to where it's been trending before. So, for example, if price has been moving bullishly, it reacts at this point here, continues to move bullishly, and reacts at this point here, and then continues to move bullishly. Okay, at the point where there was a reaction, so price had been moving straight and then decided to move in a different direction, whether it be with 2 or more candles. There must be at least 2 or more candles going in the other direction for me to ascertain whether there is a support or resistance zone there. If there is just one candle rejection, it's not a very high chance that I'm going to class that as a significant area of support and resistance on the 4-hour. We will then mark the top of the wick to the body of that candle, or the average of the bodies of candles that are sitting over here. Okay, and I'll show you that again later with a diagram with live price. Price then continues to push up and it starts to react at this zone. Let's say that price is still within this zone, okay, so that I can show you how we utilize this. Okay, so we've got an area of resistance here, which then price breaks through, could potentially turn into an area of support later on. But the most important thing is just drawing these zones at any place where price has turned around at. Okay, that's on the 4-hour. Again, it's not going to be the same for everyone. It's a rough guide, and it does save your ass a lot of the time. So why do we draw this out? It's simple, so that we can get high probability scalp trades on the lower time frames. It keeps you safe. What do I mean by this? Okay, it keeps you safe because we are not going to be taking trades into these zones because they are brick walls of price on the higher time frames. We are not going to take shorts if we are at the bottom of this range because we are going to be trading into a brick wall. There's not enough space there for our full target to be realized. Similarly, if price is currently at this zone, we're not going to be taking buys into this brick wall of price. Okay, the only time we're going to be taking buys if we are up here is if we then break through this. Then we can start to take buys away from this zone. Okay, it's that simple. That is how I determine where I'm trading on the lower time frame based on higher time frame structure. It's very important that you understand this and that this is deeply ingrained in your mind, because if you're just taking trades on the 5-minute time frame, it's almost like trading in the dark. It's like trying to get to a location where you don't have your Google Maps with you. You can't see a bird's eye view of where you're going. All you can see is the next corner and the next corner. You cannot see what's coming next. And that's what this does for you. It gives you a zoomed out bird's eye view so that you can take high probability trades. Okay. It's very important that you do this. And again, I will show you how I do that right now on the 4-hour time frame. So let's get onto the 4-hour time frame and mark out some support and resistance zones. Again, super basic. Most of you know what support and resistance is. This is just for beginners who don't quite have experience with this. I'll show you exactly what I mean right now. So as you can see, price pushes in this particular direction and then starts to retrace over here. Looks pretty similar to what I drew earlier, right? So essentially, you would draw a zone here. You look at the average of where these bodies and wicks are, and you draw it right across. What do you notice as well? Price reacts here, okay, towards the left, towards the right, okay? It's that simple. You can see here that there are some wicks as well. I might just include those as well, okay? Don't want the zone to be too big. What you can see is price broke through, reacted, and kept pushing. Price then came up, reacted with multiple candles. See here, this candle technically reacted, but it's just one candle. We want to see at least a couple, multiple candles pushing in the other direction significantly relative to what price has already done. Okay, this is nothing relative to this. Okay, it's important to note that, yes, there is a bit of discretion in this, but this part of the strategy is just a framework for the more mechanical rules that follow. Okay, so you can draw your resistance zone right across. You can then see price pushes up a bit more and then retraces with multiple candles to the downside. You can then also draw that across. You can see how price literally wicked this going forward. Okay. Now, again, why do we draw these levels? It's pretty simple. We're simply going to be trading within these zones, okay? We're not going to be trading into these zones. Now, another thing that you want to be looking out for are wicks that react at certain zones. So you can see this wick has had multiple reactions. Here's another reaction, and you can draw it right across. You can also include these wicks over here. So again, that's another significant zone that has had multiple reactions. That's another way for you to draw these support and resistance zones, is looking for areas where there has been multiple reactions at those particular zones. That signifies that that area is an area of sensitivity that you want to be mindful of when trading on the lower time frames. What you will notice is that there's a lot of free-flowing price at these open areas, and that's what we want. We want price to move freely at those zones. We don't want to have areas that are causing traffic jams to trade into. So that is a basic guide on how to draw these 4-hour support and resistance zones. You can also note, like we showed earlier, there are swing points in the market. So price pushed up, retraced. This would be our swing low here. This here would be our swing high. Okay. We then have price pushing through, retracing. Okay. Swing low, swing high. So when we get to this point here, we would then be able to ascertain that price is bullish. Price retraces and continues bullish for a little while, and then it changes momentum to be bearish. Okay, you can see there are multiple bearish swing points. So this would be our swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing, and then it continues the pattern lower. There was a bit of a liquidity grab here, and the pattern continues lower. Okay, now that is how you determine your higher time frame bias. So the next part about this is the meat and potatoes of the strategy, and that is putting the higher time frame in with the lower time frame and actually entering the market. Now I'm going to show you exactly how we do that step by step. So it's a 5-step process. So the 5-step scalp model goes as follows. We work out our 4-hour support and resistance, as well as take note of our swing points in the market. We then look at 5-minute support and resistance, okay, which is what we're going to use to determine our ranges with which we are going to trade with. We're also going to be looking at our 50 SMA, which can be really, really helpful, okay, really, really helpful when trading. We then look at the 5-minute entry. When are we actually going to get into the market? Okay, once we've determined our 5-minute range that we're looking for a break of, we're then going to look at trade management. How are we actually going to manage these trades once we're in them? And how are we going to make sure that long-term we are profitable? Right, so let's have a look at a recent trade that I took so that I can show you how it works with real data. So firstly, we would mark up our 4-hour support and resistance relative to where we are at the moment in price. So we are currently here in price. So let's look at the zones closest to that. So the first zone would be, of course, up here. Okay, this is where price turned around at multiple times. You can even draw it across. Price had turned around multiple times at that zone. The next zone that we would look at is, you can see here, price pushed down and went the opposite way. There's some wicks here, which is also quite telling. You can see if we pull it across, we've also had a rejection there and a rejection over here. So those are the zones that we're kind of within right now, trading within. And essentially what we're going to look to do is trade again within them. We're kind of in the middle over here. There is a little bit of room here to trade. If we were up here, once again, I would not be looking to trade it. You can also see that the 50 simple moving average is here as well, which can, as you can see, cause some resistance at that zone. We would then look for our 5-minute support and resistance, right? 5-minute support and resistance and our 5-minute range. Again, where has price turned around from multiple times? You can see these wicks over here. It's quite obvious that there's an area of support and resistance over here, okay? You then have an area of support and resistance down here, okay? Obviously, we've got wicks that bounce here multiple times, okay? And so those are the two zones that I'm looking to trade from on the 5-minute. So I'm basically looking for price to either break out over here or for price to break out down here. Now, once again, what direction are we favoring? Okay, At the moment, we would be favoring sells. However, like I said, we can take trades against that bias, especially if we have all of our other confluences. It's just an extra confluence. So price has pushed down, retraced, pushed down, retraced. Once again, multiple swing lows and swing highs in the market pushing to the downside, okay? So price has broken structures to the downside multiple times, meaning we are bearish, okay, in momentum. However, we can still take trades to the upside given the fact that we have some room here to play with, okay? And we're in the middle of the zone, okay? So what we would then look at is to wait for price to break out of the zone on the 5 minute, okay? Remembering that that is the key thing that we're looking for here. Now, the 50 SMA, okay? After we've marked out our 5 minute support and resistance, the next step is the 50 SMA, okay? The 50 SMA is the simple moving average, okay? You can simply go search for moving averages or simple moving average. So either SMA, you can put it in here, or simple moving average, and it's a 50, okay? So you'll just simply turn on length to 50, source to close, and click OK. You'll then have a line like this on the chart. We use this simply if we are above, we will only take buys. If we are below, we will only take sells. It's that simple. And that is a hard rule. We do not go against that, okay? That is a hard rule in this strategy, much like what I'm going to show you next. So that's the 50 SMA. Then we've got the 5 minute entry. So the 5 minute entry, as I alluded to earlier, is simple. We're waiting for price to break out from the zone, retest, and continue going. Similarly, we could also look for price to break out of the zone, retest, and continue going, okay? That's what we're looking for, and I'm going to show you in detail the criteria that must be followed for this to happen, okay? So what has to happen for this to be a valid trade? Price must break out of your range. It must break and close. It cannot just break out, because what sometimes ends up happening is price wicks out and then breaks back into the range and then continues lower, okay? That sometimes happens, and that's what keeps us safe, waiting for price to close above the range, okay? It's very, very important. So essentially, we're waiting for price to break and close above the range. We're then looking for a retest on our support and resistance zone on the 5 minute, and then we can take it long. We're also looking for a few very specific things when price retests at that zone, okay? Very, very important. So let me show you exactly how this trade played out. Again, we took this trade on our live stream as well, okay? And we recorded all of the results for this. So price continues, bounces off of the low once again. It then is still ranging within the zone. Still, this is what I'm talking about right here. Price wicks out, fakes everybody out here, and then breaks back in, okay? We would not be in a trade because we're waiting for price to break out and close, okay? Price then breaks out, closes with this huge wick, okay? And then we would be looking for entries once price retests over here. So essentially, what we look for in real time, and this is what makes it a little bit difficult to simulate on bar replay, and why when I teach students, I give them homework of taking trades with the live market over weeks and weeks and weeks, because that's the best way to learn, because we're looking at live price. So when price gets back to the zone, I'm waiting for it to start hesitating at the zone. It cannot just boom, smash straight through, okay? And there has been times when I've been cocky and price smashes through this, okay, and doesn't even hesitate at all. But I am like, oh, it's going to start rejecting soon. So I get in here and price just keeps smashing through, okay? We don't want to do that. We want to see price hesitate at the zone in real time. Again, we can't see that on bar replay. We want to see it hesitate in real time and then start to reject it a little bit. So you would get in roughly here, okay, and then go long, okay? So again, hesitation and a rejection, then we get in. So In this case, we got in over here once there was a bit of a rejection, so we would have gotten a bit higher up. We use about a 25 pip stop, between 20 and 25 pips. In this case, you can see there was a big move here, so we're going to opt for the full 25 pips on this one. Okay, and we're then looking for 1 to 2 risk reward. Okay, we would get in right here, and there you go. On the next candle, full TP hit. Okay, you can see like price started rejecting here in real time, and I can't show that again. I can't show that with bar replay, but when it got to the zone, you can see it would struggle to get through here, and then it starts to reject, and then we get in. It's as simple as that, and that confirms to us that there is something at that zone. There are orders at that zone, and that doesn't mean that it's not going to be, there's going to be zero drawdown, although in a lot of cases there is almost zero drawdown, but it means that there's going to be a reaction at the zone, more than likely. Okay, and a lot of the time we don't have a lot of drawdown, and sometimes trades last less than 5 minutes. Basically, one candle finishes the whole trade, which is great when it happens, but you do have to be quick. Okay, and that's why we live stream everything, because that's the only way that you can see this work in real time. Okay, then the last thing is trade management. So when it comes to trade management, once again, we get in here. Once the price has rejected and hesitated at the zone, we get in. Then in terms of trade management, when price has gotten to 50% of your zone, basically a 1-to-1, we then go break even. But there is a caveat to this. So for my personal trading style, some of you won't do this, but this is what I do. This is a bit of a insight into my experience with this. I wait for price to push through our 50% zone. So I will use this 50% GAN box here. I'll mark on the 50% here. And I do this again, all live on stream. In the Discord below is the link to join if you want to join us for free on stream and join our community with lots of like-minded people that are also trying to get funded and get profitable. It's free to join. Essentially, once price breaks through here, I want it to break convincingly before I go break even. What I mean by that is it cannot just like go like this, wick out, and then come back. I want to see price really push convincingly through this zone, and then I will go break even. Okay, so that's how I personally do it. Again, this takes a bit of experience, but after a while of trading this, and after trading this for months and months, you eventually get the hang of it, and it works really, really well. You can, however, still go break even at this zone, but you will still get a few more break-even trades. Okay, and with this system, the one caveat is that you do get a lot of break-even trades, and that's because we manage trades quite aggressively. Again, some of you might not like that. You would maybe prefer to take more losses, but then get more TPs rather than break evens. But for me, I prefer to get more wins and have a higher win rate. And that's why over the last 5 months, we've got a 70% win rate, just below 70%. And we've recorded every single trade that we've taken, all of it live on stream. So if I'm talking nonsense, the stream will call me out, okay? The whole community of over 6,000 people will call me out on that. All right, so that is trade management. And that's how you get into a trade with this strategy. But that's not the only way, the only thing that's going to get you to 40 pips, okay? The next thing you look at is actually getting funded, because you need to get funded if you want to actually make any money with this. Right, so let's talk about how to get funded quick, but also in a safe way. Now, you're able to achieve this using a concept called dynamic risk. Dynamic risk is simply where your risk changes based on where you are right now in your trading profit. So what you're going to do is quite simple. When you're at 0 starting your account, you're going to risk 1% like you normally would. All right. Once you get to 3% plus, okay, you're then going to risk 2%. Okay. Once you get to 3%, so once you get to here, okay, You can then risk 2% plus. Okay. Now, once you get, okay, if you're having a really bad time and you get yourself into a little bit of drawdown and you get to 3%, okay, you can then, you're minus 3% in drawdown, you then remove risk by only risking 0.5, okay, risk. Now, what this does is it minimizes your downside risk, okay, but maximizes your upside profit. Because you've got dynamic risk, you can pass your challenge quickly, but because similarly, when you go into a drawdown, you can then minimize your risk on the downside. Now, also what this allows you to do is once you're on a winning streak, it allows you to maximize and pass your challenge as quickly as possible. But when you're in a losing streak, you can minimize your risk, keeping your account quite safe. Okay, this is really, really important because, again, if you're able to combine this with a strategy that has a 50 to 60 to maybe even 70, like we've gotten very close to recently in our live streams, % win rate, you can seriously pass challenges quickly, like really quickly. This is exactly how I do it. Once I'm in a 3% and above profit, I then continue to risk twice as much. So I'm risking 2% per trade from 3% profit and up. If I then go into a drawdown of -3 and below, I'm risking 0.5% only. Okay, limiting downside risk and maximizing upside potential so that I can pass as quickly as possible, because we do not want to be passing accounts for days and months and months. Because let me tell you, passing an account slowly can be just as bad as just being a degenerate gambler, because when you're taking long to pass an account, something goes wrong in your head where you start to get impatient. Because if you've spent a couple of months trying to pass this account, you eventually get fed up and say, screw it, I'm just going to full leverage this account. If I pass, I pass. If I don't, I don't. If that was you recently, and I know there's a lot of you, comment down below and let me know, because that's happened to me very many times until I started to implement dynamic risk like this so that I can pass challenges quicker but still stay safer. Okay, there are ways that you can risk more, pass quicker, but still stay safe. And this is one of them. However, what I'm going to show you next, when combined with this, can be extremely, extremely powerful. Okay, extremely powerful. So once you've gotten your risk management correct, you're then going to use this system here to get paid consistently every month. Okay, now when you are trading, you want to make sure that you get paid every month. And you might say to me, oh, but Ethan, how can I get paid every month? Trading isn't consistent every month. Trading is up and down. Market conditions change. And this is true. 100% true. So how on earth can you expect to get paid every month? A lot of you want to quit your day job. How can you quit your day job if you're not going to get paid regularly for the thing that you're looking to replace your earnings with? Okay, that would be absolutely stupid. Now, there is a way to do this with prop firms. Again, once you've taken skill number 1, you're able to pass prop firms quickly, and you're able to do them in a very, very small amount of time while still being quite risk averse. Okay, and that is key. So what you're going to want to do is the following. Firstly, if you can afford to get a 100K account and that's all you can afford, don't. Just don't. Don't get a 100K account. Please don't do that. What you're going to do instead is divide that by 4. You do not want to get a 100, or even if you can afford to get a 200K account, do not get that 200K account. And I'll tell you why. This is to do with your mindset. If you're spending all your money on that 200K account, and you know that in 6 months from now, you are not going to be able to afford to get an account until you've saved up for 6 months to get another one, then let me tell you, that account you're going to be very attached to. So the problem with being attached to things is that we have expectations. When we have expectations, we have pressure. When we have pressure, we make terrible decisions. And it's the same for trading. If we make decisions under pressure, they're going to be poor decisions. When we're under pressure, we tend to make decisions we would not normally make. And this comes down to human psychology. So what we want to do is alleviate that pressure as much as humanly possible. And this is something you need to work into your trading strategy. All right. And that's why we implement this. So instead of getting yourself your 200K account that you'll only be able to purchase another one of in 6 months because you've now put yourself under significant pressure. People take loans, people take their rent money, people take whatever their alimony money and they put it straight into their funded accounts. That is not smart. You're setting yourself up for instant failure because the pressure will be too much. So how do we alleviate this pressure? We simply give ourselves some room to breathe. And what we do is we take our 200K account that we could afford to get and divide it into 4. We get 4 50K accounts. Now, this allows us, and you don't have to buy all 4 at once, by the way. You can just buy one and know that you can buy the others later if you need to. This will do 2 things for you. Firstly, it allows you to use this methodology that I'm about to show you to make sure you get paid out every month. That's actually the most important thing. Secondly, you're not going to be pressured to get this one account because you've got to make it this one time. It's your last chance for another 6 months. Otherwise, I'm going to have to go back to my terrible job that I hate doing. And I've got no hope until 6 months from now when I get this new account. You do not have that mentality. With this, I've got breathing room. I know that if worse comes to worse, I can get another account if I need to. That's not to say we're trying to lose accounts here. Okay, but we can now breathe. Okay, it's very important. So once we get our first account, knowing that we can still purchase 3 more if we need to, we then go and employ the dynamic risk management that I spoke about earlier to pass this account, which will allow us to pass the account very quickly. Okay, you might go into some drawdown and then you're going to have to then work your way out of that for a little while. But if you're in profit and you start getting into your stride, you will pass very quickly. And if you've got a strategy like ours, you will be in profit quite often. And I'll tell you that. You can ask people within our community how often we're in profit. Many people come in there with their prop firm challenges in big drawdown and end up being in a profit. This is something that I see happen over and over again in this community, guys. Again, it's free for you to join. The link is down below. So now that we've got these 4 accounts, right? These 4 accounts are going to be our banks. They're going to be our safety nets, okay? And it's like a game of Who Wants to Be a Millionaire? You know that game show? Essentially, you're answering questions or taking trades, and you're going to get to a certain point where you've won a few times and you want to set a safety net. That's the same as this. You set your safety net so you go home with a little bit of money at the end of the day, whatever the outcome. And that's what this is, okay? So I'll show you exactly what I mean right now. So essentially, what we're going to do is diversify our risk, all right? So when we diversify risk, we're essentially going to be taking different trades every single day on different accounts, all right? We've got 450K accounts that are funded. We can ensure that we get at least one payout this month, even if we have one of the worst trading months ever. If we are diversifying risk, we've got a trading strategy that has over 50% win rate with a 1 to 2 risk reward. We will get paid out this month. I am very confident in that. Okay. Now, even if we have all losses, guess what? If we're risking 1% per trade, we're only going to be $500 in drawdown on each of these accounts. Now, in 1 week of trading, if you take 4 trades, 1 trade per day, tell me at least one of those trades is going to be profitable. So let's say all of these trades are losses. All of them are losses. We're minus $500 on each of these accounts because we take 1 trade here, 1 trade here, 1 trade here. Okay. Now we're going to be in drawdown $500 on each of those accounts. But then on the final day, we get a winning trade. We're then going to be up $1,000 because remember, 1-to-2 risk reward ratio. All of these accounts over here are going to be minus 500. Now, tell me, if I then go and set this account aside, what am I risking? Nothing, because I've got this payout and I'm going home with $1,000 at the end of the month, no matter what happens. You set the account aside and you wait for payday. That's all you do. Then you come back to these 3 accounts and you diversify your risk across all of them. Now tell me, the next 3 trades, what are the odds that at least one of those trades is going to be a winner? It's pretty high, right? So, especially if you got a 50% win rate, if I had to flip a coin right now and I had to flip it 3 times, you would be pretty comfortable betting that it would at least one time be heads. It's not going to be tails all 3 times. There is a possibility that that will happen, but it's quite low. Okay, so if one of these wins, we're then up $500 because we would win 1,000 and we were down minus 500. Okay, so one of these accounts is up 1%. Now we still got 2 accounts in drawdown. Okay, and you guys can start to see what I'm talking about. But then what do? We set aside this one account here and we wait for payday. Now we've paid ourselves $1,500, which is sitting risk-free. Think about how great that will feel, okay? And also think about how you can scale this. Because currently I have 6 or 7 different accounts that I'm doing this exact same thing with, all 200K accounts. Now imagine, all I need is 1 or 2% per account and I've made over $10,000. And that's exactly what I try to do. So then you'll ask me, okay, how am I getting these big 15% withdrawals on prop firms? Okay, I got $26,000 with Ascend-X. Oh, you're telling me you're only taking 1 or 2%. How are you getting these huge withdrawals? I'll explain it to you very shortly. So what eventually happens some of these months is I'm fortunate enough to have all of my accounts in 1 to 2% profit. So let's say these ones only have 1% and we've got one that's 2%. What do? I then take one of these accounts, let's say the one that's already up quite a bit, take one of them, I've still banked 1,500. I'm getting paid at the end of the month. I'm also working, for example, maybe on another prop account that I'm trying to a challenge that I'm trying to pass. So there's potentially another account coming in the pipeline. So I'm not so worried. This account, okay, that I've now marked out, this account here, I take it and I apply dynamic risk management to it. Tell me, if you're able to get between 8 and 10% to pass a challenge, if you're having a good month and you take one of these accounts and you apply dynamic risk management to it, where if you're above 3%, you're now risking 2%. But then if you go into drawdown, you then half your risk. The chances of you going into a heavy drawdown is very minimal, but the chances of you winning and getting a big 8 to 10% payout is quite large. Because I've done this and I've done it multiple times. The same time when I got 18% with Effectify and I got $26,000 with I got $26,000 with Ascend-X. Okay, this is what I did. I had all my profits banked, and I had one account that I was more aggressive with dynamic risk on the same dynamic risk portfolio that I have laid out over here for you guys. So what you're able to do down the line is use dynamic risk to get big payouts every few months, but then have other accounts where you can be a bit more conservative and pay yourself monthly because you're diversifying risk. Now, the reason you're able to take these big risks on one account, again, is because you've got a mindset of abundance. You've got multiple accounts. Those accounts are going to be fresh and new to trade next month and pay you. They also have guaranteed profits in them that you're simply waiting to come to you. So you feel completely comfortable with taking larger risk on trades. This here is the blueprint to rinsing prop firms, absolutely rinsing prop firms and taking full advantage of this. You'll also note that some small prop firms have rules, consistency rules, specifically to prevent traders from doing this. Why? Because it's a risk to them. It gives a trader such an advantage, and they've noticed that traders do this, that they had to figure out a rule to limit this kind of trading. And luckily, it's only a few small prop firms that do this, but they did it nonetheless because it's such a threat to them. Okay? And that is how you get funded in the first place, and how you make sure that you get paid consistently with prop firms in an industry that is very inconsistent and up and down. You simply play the numbers, and prop firms allow us to have this leverage that makes it make so much sense to trade this way. And I don't know why more people don't do it. And that is my full 40 pips per day trading strategy. If you want to trade along with me, click the link in the description below and you can trade alongside me every single day completely for free. And you can chat to like-minded traders, much like yourself, trying to become profitable, get funded. Cheers, everybody. See you in the next one.